When massive structural forces across multiple timeframes perfectly align in the market, price action follows a very specific and highly repeatable sequence. The Nifty index is currently displaying signs of this alignment, where price behavior suggests high-volume activity has established a new directional baseline. This multi-timeframe posture creates a buy-on-dips execution bias, anchored by the 24,500 level. To navigate this, we will deconstruct the macro footprints, define the structural levels, and map the asymmetric intraday strategies required for execution. Trading without macro context relies on guesswork. Structural mapping allows us to translate price history into a quantifiable statistical edge. This monthly chart of the Nifty index shows a deep liquidity sweep. This is the starting point for our macro analysis. Notice the long lower shadows on these recent candles. This specific price action indicates aggressive institutional absorption between 22,000 and 22,500. This absorption fueled a rally that cleared the intermediate supply zone between 24,200 and 24,500, with price now holding at 24,570. Clearing this supply opens the pathway toward the all-time high structural zone at 26,373. These massive macro liquidity sweeps, followed immediately by strong supply invalidation, provide the necessary rocket fuel for sustained multi-month bullish continuations. On the weekly chart, we can see the momentum of the current bullish expansion and the resulting reclaim of previous levels. The prior major swing low between 23,000 and 23,200 acts as the macro demand base for this cycle. Price has pushed past the persistent supply block that was holding between 24,200 and 24,500. This creates a structural polarity shift, where the former supply zone now functions as a demand floor. A polarity shift confirmed on a weekly close is a strong technical indicator of a regime change from distribution to accumulation. The daily time frame confirms this sequence with a series of higher highs and higher lows, driven by high-volume breakouts. Current consolidation is occurring above the 24,500 level we identified on the higher timeframes. The buy-on-dips mode remains active as long as daily closes stay above 24,500. Monitoring daily closes relative to these polarity zones prevents traders from reacting prematurely to intraday volatility. For positional traders, long exposure is maintained as long as the 24,200 level holds on a weekly closing basis. The upside targets scale from 25,200 to 25,800 and finally to the 26,370 all-time high retest. In this environment, positional short trades are structurally invalid as the trend is against them. A short bias only becomes viable if the index registers a decisive daily close below 24,200. Ultimately, successful long-term trading relies on asymmetrical risk, letting your targets run while heavily leaning on defined structural invalidation points. On the 15-minute chart, we can map the immediate price action following the rally to 24,774. Price has pulled back into a consolidation channel between 24,550 and 24,650. Overhead resistance sits between 24,650 and 24,680, which stands before the swing high target of 24,775. Immediate polarity support rests at 24,550 to 24,570, backed by the structural demand base at 24,500. Consolidation occurring just above macro polarity floors creates high risk-to-reward opportunities for intraday setups. We have 3 execution scenarios for Monday. The first is the bullish breakout play. This play is triggered by a sustained 15-minute candle close above 24,650. The targets are 24,720 and 24,775, with a stop-loss placed below 24,590. The second scenario is the bullish dip buy play, focusing on a support flip during the morning session. This is triggered by a drop toward 24,530 to 24,550 that shows 5-minute bullish absorption, such as a hammer candle. The targets are 24,620 and 24,680, with the invalidation stop-loss below 24,480. The final scenario is the bearish rejection play, used only for short-term scalping. This is triggered by a rejection at 24,680 or a breakdown below the 24,500 base. Downside targets are 24,420 and 24,350, with a tight stop-loss above 24,560. Professional execution involves having pre-calculated risk parameters for each structural probability. Multi-timeframe analysis shows that institutional absorption has shifted the former supply zone into a demand floor. The directional bias remains long toward 26,370, provided the 24,500 daily and 24,200 weekly floors hold. In markets driven by macro liquidity, shorting is a tactical scalp only. Respect the polarity floors and execute level to level.